All right, good evening, everybody. We continue with our study in corporate finance today, how we value companies. We've worked our way through a bunch of different ways. We've worked our way through the net present value looks. We've looked at bonds, and we've used net present value to figure out the price of bonds. And before I go too far, can somebody just give me a nod or a heads up to tell me that you can hear me, please? Perfect. Thank you very much. All right. So today we talk about debt. In particular, we talk about the limits of debt. Um, because theoretically you can issue as much debt as you want, but eventually the market becomes saturated with the debt you want to issue, and nobody else wants to buy it, and then you've got a problem. So we're going to talk about that a little bit today and how we know when we're approaching that level. It is chapter 17, not chapter 7. But we also need a little bit of background from chapter 16, so I'm going to delve into that first, then leap into chapter 17 and then go forward. As usual, we'll go till about 8 p.m. We'll have a bit of a break and then we'll continue afterwards. Have a great evening, gentlemen and ladies. Thank you very much. Okay, so we have our land acknowledgement. We are on the land stewarded by the Anishinaabe, Haudenosaunee, and Wendat nations. We acknowledge Treaty 13, Toronto Purchase Island, the Mississaugas, the Credit First Nation, and the Williams Treaty. We recognize that this is land that we are borrowing and must return, and we are stewarding it until such time. Specifically, today we're looking at Chapter 17. Chapter 17 talks about how we get a cost of debt and how we set up a capital structure. Remember, the capital structure is really just the balance of how we source money for our company. So we can borrow it, we can issue debt, we can ask mom and dad for it. But whatever we do, the combination of all of those is called our capital structure. When we talk about capital structures, we have to talk about some of the costs involved in them, particularly the costs involved in debt. One of the hidden costs of debt that we don't really think about first is the cost of financial distress. And we'll talk about it a little bit in a minute, but what goes into the cost of financial distress and what that means in terms of what we have to build into the cost of everything else is really kind of important. Then we talk about, can the cost of debts be reduced? Some of it, yes, some of it, no. And then we're going to talk about tax effects and how that offsets some of the other costs we have, signaling, shirking perquisites, etc., the Peckson theory, and then personal taxes. As I said, though, before we get there, we have to talk a little bit about chapter 16. So give me a second. The beer industry. In 2023, something happened that nobody expected. There was a shift in appetite, a phenomenal fundamental shift in appetite. To some degree, it was actually caused by the very people it's hurting. And if you go back in time and remember 2023, it's a period where we had everybody fighting with each other online. Still doing it, I suppose, but that was really the start of it, the start of everybody negotiating what they wanted to do politically through Twitter. And if you remember, at one point they went after Anheuser-Busch and particularly Bud Light, because Bud Light had the audacity to have an ad that not everybody agreed with. That caused them not only to turn against Bud Light, and it wasn't a temporary turn. Bud Light went from the top selling beer in North America, and it has never made it back above third place since then. In fact, first place is Modelo, second place is Corona, and third place is Bud Light. And there's irony there, and I fully appreciate the irony. As this was happening, people were actually switching out of beer and into other stuff. Wine, seltzers. We started to get the introduction of a lot of pre-made seltzers and pre-made drinks, and that's what people gravitated to instead of beer. The net result being, in 2023, we had 385 breweries filed for bankruptcy in the U.S. COVID was a factor, but certainly not the main factor. One of the main factors was during COVID, the Federal Reserve and other central banks in the world rushed in to try to prop up the economies that were getting destroyed by dropping interest rates to zero. It worked to a degree, but it also caused a problem because now rates are zero. Let's issue as much debt as we want to. And that's exactly what happened. A lot of these companies were lured by this cheap debt saying there's never going to be a better time. Well, there wasn't a better time. The problem was when we came out of COVID and they started hiking rates, that's when things turned sour. And stuff that you could afford at zero interest rates, you can't afford at 3, 4, 5% interest rates. And that's why we had all of these companies fail. Ostensibly, one of the reasons that they all failed is they had a poor capital structure. They relied on cheaper debt, and that can't turn around to bite them. So let's figure out why. So when we talk about trying to decide what our capital structure is going to look like, Chapter 16 gives us a quick introduction, and we don't teach it. So I'm just going to give you what's in the introduction here. And it's a free, there's no tests on it, so don't worry too much. But if you think of the pie model on the right side of the screen here, the firm's value is a combination of the debt and equity you hold. We already know that assets equal debt and equity. So if we're happy to say that assets are the value of the company, then the flip side of that is it must be made up of debt and equity. If you have zero debt, so let's think of a company. We have a company called JJ Spray, has a value of $1,000. It has zero debt. It has 100 shares valued $10 each. It is completely unlevered. Now, we have a plan. We're going to borrow $500 and use that to distribute cash out of the company back to shareholders in the form of a $5 dividend. The dividend has each one of those $100 shares is going to receive $5 each, and there's our $500 right there. What happens to this company after we issue those shares? Well, there's only a couple of real possibilities. After we invest the money and distribute the shares, either the firm has the same value we started with, which is $1,000, the firm is worth more than $1,000, or the firm is worth less than $1,000. Those are our only three choices. And in fact, when you start to get into the trading world, there's only three things that can ever happen with the trade. Either it goes up, it goes down, or it's unchanged. And that's just the way it is. So we have three things that could happen. What actually happens? Well, we went to investment bankers and said, what's going to happen if we borrow this money? And the investment banker said, you know something, you're probably not going to have a change in value of your company by more than $250 in either direction. So either it goes down to $750, it stays unchanged at $1,000, or it goes up to $1,250. Those are the only possible alternatives. So if we start here with our original capital structure, we have zero debt and $1,000 equity for a total firm value of $1,000. Now we issue $500 in debt. So we get that $500 in debt. Now either we're now worth $1,000 where we have the $500 in debt. We paid out $500 in dividends. So that had to come out of the ownership of the company. That's the only way you can do dividends, right? It has to be retained earnings. And if it's retained earnings, it is part of the value of the company. So when you issue dividends or pay dividends, you are paying out part of the value of the company. And when we issued our $500 in bonds, we paid out $500 in dividends, and that dropped our equity to $500. So we're still worth $1,000. That's one possible outcome. Another possible outcome is we borrowed the money, our stock went up, and then we sold, we distributed the $500, took that out of our new higher equity model, and we're left with $750 in equity. So in that case, our firm went up by $250. And the other alternative is we issued debt, and then we started paying stuff out, and then bad things happened, and our equity fell in value, and now we're only worth $750. So those are the three things that could happen. What's the most likely outcome? Capital gains change to reflect the equity value of the company. Does restructuring change the value of the firm to stockholders? I'm now long the shares still. I've still had my original 500 shares. I have been paid $500 in dividends. What's the rest of the company worth? Well, we look on the right side here, the payoff to shareholders. You see capital gains. The dividends are $500. That's unquestioned. If we have capital gains involved of $250, then the net gain to shareholders is the $500 I've just given you, less the $250 in capital gains. Or we actually give out the $500 in dividends, which are associated with $500 in capital gains. So we actually have no change in value. Or I give you $500 and the capital gains attached to that's actually $750. Now we have a decline in $250. Those are the only three things that could happen. To demonstrate that, as usual, I have my spreadsheet here. And I don't have that on my spreadsheet. Sorry. So those are our three choices. Either we go up by 250, we have no change, or we go down by 250. Let's look at totally different company to see what happens. Trans Am Corporation, a very simple balance sheet. It's on the right. We have assets of $8,000. Debt is zero, equity of $8,000. Assume a couple of other things in the background. Interest rates are 10%. Our shares are 400 shares worth $20 a piece for $8,000. So now we have our assets of $8,000. We have our equity of $8,000, which is 400 shares of $20 a share. And we know that interest rates are sitting up there at 10%. Now what happens? Now we add 4,000 in debt. Our assets remain at 8,000. Our debt's now 4,000. We know that assets have to equal debt plus equity. Our equity has to be 4,000. Has to be to balance. So what happened? Where did the extra $4,000 go? It had to have left the system. We must have paid it out somehow. We must have paid it out in dividends. We must have either had a depreciation in the value of our debt, but somehow we paid out that $4,000. We had to. Another thing happens though. Now that we've borrowed this $4,000 in debt, remember interest rates are sitting at 10%. So whatever happens next year we owe $400 in interest. So now we have assets of 8,000, we have debt of 4,000, we have equity of 4,000, and we're sitting on the fact that we're about to have to pay somebody $400. So what happens? Well, let's look at three possible outcomes. Next year, we have earnings of either $400, $1,200, or $2,000. If we have 400 shares outstanding and we have $400 in earnings, we have $1 per share of earnings. If we have 400 shares outstanding, we have $1,200 earnings, we have $3 per share. And if we have 400 shares and 2,000 in earnings, we have $5 per share of earnings. What does this translate into? Well, $400. Here we are. We have a return on equity of $400 divided by 8,000 in equity. 5% return on equity. $1,200 divided by 8,000, 15% equity. 2,000 divided by 8,000, 25% equity. Now we're going to add the debt. Now our equity goes down to 4,000. We have 4,000 in debt, and we have 8,000 in assets. We still have our $400, $1,200, and $2,000 in earnings, but now we also have interest. Now we've got $400 in interest because it's 10% interest on that $4,000 of debt. Now we have earnings before interest of $400. We have interest of $400. We have bupkis in terms of earnings after interest. There's nothing. We've used it all up. Our return on equity goes from 5% to 0. Our earnings per share is uncalculable because it's 0 divided by anything. If we had looked at the case with the $1,200, we have $1,200 in interest before earnings before interest. We have $400 in interest. Earnings after interest is $800. Our earnings per share has actually gone up to 20% from 15%. What happens in the other one? In the other one, because it's $800 divided by 4,000 is 20%. So in the next case, we have a $2,000 in earnings. We have $400 in interest. Earnings after interest is $1,600. $1,600 divided by the new $4,000 in equity is 40% equity. We have managed by adding debt to juice our equity numbers by 5% in the case of a modest $1,200, and by 15% in the case of a relatively decent growth of $2,000. What's happening to our earnings per share? Well, in the case where we make no money, we have no earnings per share, so don't worry about too much. In the case where we make $800, our earnings per share went from $3 to $4. And in the case where we now made $1,600, our earnings per share went from $5 to $8. So this shows you what happens when you can play with the capital structure of your company, depending on what you're trying to accomplish. Are we looking for returns to our shareholders? As a shareholder, I would hope yes. Now, the question is, as a company, what motivates us? Are we trying to keep our shareholders happy? Are we trying to keep our bondholders happy? Are we trying to keep our banks happy? You already know where I stand on banks, so let's not worry about that too much. But the answer is you got to keep your shareholders happy, because the shareholders are owners of the company. The bondholders you just owe money to. But you got to keep the owners of the company happy. Now, curiously, in the pecking order, shareholders are last. Bondholders are way ahead of them. So when it comes time to liquidate and pay for stuff, we look at it in the reverse order, but that's really not our problem. Now, if we go to the right side here, on the bottom side, we have an interesting graph. The first line, going from 0 to 4, is our earnings. Earnings per share, $4 per share. And this is with no debt. So we're looking pure equity earnings. Now, when we add debt, what happens? When we add debt, we start to see a shift because we have to account for the cost of the debt. And we see this initial negative here, but we have the same break-even point. Our break-even point isn't going to change. It's just going to pivot. And we're going to move around that break-even point. Everything to the bottom of it is the disadvantage to using debt. And that's where your returns are lower than if you had pure equity. On the upper half of the line, we have advantages to owning debt. And that's where your earnings are above where they would have been if you're using only equity. And we know this area exists because that's exactly what we just calculated over here. Is there a pure relationship here now? Is it something that we can look at and say, that's pretty cool, I like that. Can you put it into a equation for me so I can just remember the equation? No, I can't do that either. Unfortunately, there's empirical evidence this is true, but there's not enough that we can put a pure equation together for you. We're going to get there, but we're going to get there the wrong way. So just stay with. Now we have a choice, as always. What are we looking at? When we look at return on equity, when we look at earnings per share, they definitely do better under leverage. So it's tempting to say you're always going to do better under leverage. But it's not true. Two economists, Modigliani and Miller, have worked together. We're going to come back to them a few times. But what they're saying is that by changing the capital structure of the company, and if all you change is the capital structure of the company, you cannot change the value of the company. You can change returns, but you cannot change the value of the company. If that's true, then no single capital structure is better or worse for shareholders. Now, it is true, but it's true to an extent. And we're going to come back to the true to an extent part in a minute. But if you look at the top and the bottom, you see that the results are the same, whether we buy shares in a leveraged corporation or borrow to buy shares in an unlevered firm. If we buy 100 shares of leveraged equity, do I have this down? I think I have this on my spreadsheet. Ah. The expected return is $4. The earnings per share is $400 because it's $4 per share, 400 shares. With expansion, we see the EPS jump to 8. So here we see the EPS jump from 4 to 8. The initial cost goes from 4 to 8. Now, what happens if we use homemade leverage instead? What happens if we say we have our shares, we have our borrowed money? Can we borrow the money and change the structure with the shares to impact our net earnings versus if we had just bought the levered company? And I've only done 2 examples here, but in both of those examples, the net earnings are identical. They don't change. The capital structure is not going to change the earnings of the company. Now, that's true to an extent. Miller, Modigliani, and Miller are right, but we have to be careful with how, sorry, not the earnings, the value of the company, I apologize. But we have to be careful with how we interpret this. And I'll show you in a second. The problem is risk. And risk is something that, in order to make money, we have to take on. But we have to understand the risk, and we have to understand what it is about that risk that we talk about. So, in our pre-levered firm, our earnings per share varied between $1 and $5. In our levered firm, it varies between $0 and $8. The quick synopsis of those 2 relationships are: when you're in a boom time and outperforming, your levered returns will always be better. The flip side of that, if you're in a time when we're not outperforming, we're underperforming, we're in a recession, for example, your levered returns will always be worse. That's what risk is. Expected ROE is positively correlated to leverage because risk increases with leverage. Returns increase with risk. The problem is the tails of those returns can have negativity to it, which doesn't exist in unlevered models. What we're talking now is the weighted average cost of capital. So the weighted average cost of capital says whatever the cost is of our stocks by adjusted by a risk factor, plus whatever the cost is of our debt adjusted by a different risk factor, combines together to make our weighted average cost of capital. We have to decide which we like best, but if we zip over to the right side of the page here, WACC, our weighted average cost of capital, is our bond returns, sorry, our cost of bonds over our supply of bonds and stocks times our risk adjuster, plus our cost of equity over our total amount of equity and debt times the capital, times the risk adjustment for stock. So in each case, we're taking bonds or our proportion of bonds or a proportion of equities, and we're multiplying them by our risk factor. In each case, we can see that the unlevered firm is around 15%. The levered firm is also around 15%. The value of the firm has not changed. In fact, what we look at is we have a weighted average cost of capital, which is a combination of our cost of equity and our cost of debt compared to an all equity firm. The cost of equity is equal to the cost of our all equity firm plus whatever it costs us for debt times a factor of what our relationship is debt to equity. We have some assumptions here. No taxes is a big one. No transaction costs is another one. Individuals and corporates bought and borrow at the same rate. There's no bankruptcy costs, there's no asymmetric information, and there's efficient capital markets. And in chapter 17, I'm going to blow all of those out of the water. But we need to understand what we're blowing out of the water before we start shooting it. So proposition 1, the value of a levered firm equals the value of an unlevered firm. You accept that. Proposition 2, the cost of equity rises with leverage because the risk to equity rises with leverage. As we increase leverage, we have to do something with our equity. It has to adjust. That's the risk we're talking about. All right. So that's the background we needed to get into talking about capital structures. And the important pieces here are the assumptions. No taxes, no transaction costs, individuals and corporates can borrow at the same rate. There's no bankruptcy costs or other agency costs. There's no asymmetric information and efficient capital markets. What do those mean? No taxes, one's pretty evident here. We're not paying corporate taxes. We're not paying personal taxes. In the real world, we have to pay corporate taxes and personal taxes. Some people are better at avoiding them than others, but everybody has to pay them. The assumption of no transaction costs. Reality is transaction costs are pretty high. They're not abysmally high, otherwise nobody'd do it, but you can't ignore them. Can individuals and corporations borrow at the same rate? No. Banks lend on a risk-adjusted basis. People are deemed to be more risky than corporations, which is a bit of a, I'm not sure I agree with that, but whatever. Corporations are better at reducing their risk premium than people are. No bankruptcy costs or agency costs, bunk. There's absolutely bankruptcy costs and there's absolutely agency costs. We're going to get into those in a minute. And there's no asymmetric information. As somebody that spent 25 years on trading desks, there is absolutely asymmetric information. I can tell you without a shadow of a doubt that the game is rigged, and it's rigged against you. The more you trade and the more in the market you are, the more information you have, and that is just the reality. So asymmetric information we have to be very careful with. I'd say that computerization, social media, and everything has made this asymmetry less predominant, but there's no question that it still exists. And efficient capital markets. This one I have to give you. Capital markets are largely efficient. Are they 100% efficient? Absolutely not. If everybody gets the same idea at the same time and tries to execute, we get log jams in the market. We get these explosive moves. If you follow the equity markets at all, you've seen these explosive moves, and that's what causes them. There are brief moments of inefficiency in the market, and some people are better than others at exploiting those. So, chapter 17, debt. We know from what we've just looked at that leverage increases the returns of a company. in good times. In bad times, bad things happen, but in good times, leverage is good. One of the reasons is debt provides a tax benefit to the firm. In both Canada and the US, interest on taxes are you can write off against this class should not be at 7 o'clock at night, guys. Interest can be written off against the income in your company. That reduces your tax payments. Principal repayments are a little bit tougher, but it's not impossible either. Now, if we don't make these payments, and sometimes you don't, we call this financial distress. Financial distress doesn't necessarily mean bankruptcy, but bankruptcy is the ultimate financial distress. So we can have financial distress that doesn't involve bankruptcy, there's different chapters in the US, there's different steps in Canada as well that don't lead to liquidation of the firm, but do lead to some protection for debt holders and stockholders. I am talking about a company here that I have not mentioned before. Oh, Knight Corporation and Day Corporation. That's why. Sorry, we have two corporations, Knight Corporation and Day Corporation. They both face the same economic realities, and that is we have a 50% probability of a boom and a 50% probability of a recession. In the case of a boom, they both have cash flows of $100. In the case of a recession, they both have cash flows of $50. Now, principal on the debt that's owed is $49 for Knight. So in good times, with cash flow of $100, they have distribution to stockholders left after covering principal on debt of $51. In bad times, $50 in cash flow, $49 principal on debt, they have $1 left to distribute. So it's either 51 or 1. Day Corporation has a higher level of debt. The principal on their debt is more. They're not paying 49, they're paying 60. So when we had cash flows of 100 in a good time, we have principal on the debt of 60, distribution to stockholders, $40 available. Now, if we have a recession and we only have $50 in cash flow, we owe $60 principal and we don't have it. We can only pay we can only pay $50. In that case, the bondholders are still owed $10. What happens? Now, it's important to know, they set the rules up, and whenever you can set the rules up, you have a chance to skew them slightly in your favor. Lawyers' fees are paid out before bondholders. So we have to account for legal fees first. Is this real? Well, I don't know. Realistically, before we get to the point where I have $60 that I have to pay and I only have $50 left, everybody's going to lawyer up. And when we lawyer up and get our lawyers, we start to get legal fees. Legal fees are substantial. Realistically, we're not going to be able to pay out $50 at all. We owe $60, but we're going to pay $15 in legal fees first. That means we only have $35 to pay out on the $60 in debt. That's why leverage increases the likelihood of bankruptcy. Doesn't necessarily impact cash flows, but the costs associated with bankruptcy are what result in the lower distribution to shareholders and the lower principal available to pay out debt. These are the costs of financial distress. Does every company that borrows money face them? No. Every company that borrows money has to be in a position where they understand they could face them. And that's what causes financial distress costs. Even for a healthy company, they have to account for a slight probability they may be in this position. And if that's the case, then they have to lawyer up ahead of time anyway. There will always be these associated financial distress costs associated with bond issuance. Are you going to declare bankruptcy? Probably not. Doesn't matter. So how are we going to describe these financial distress costs? What's involved? Well, a lot of people are paid way more than any of us in this room right now to decide those discussions. Accountants, $300 to $500 an hour. Lawyers, $500 to $1,000, $500 to $1,000 an hour. Financial advisors, they're tricky. They're just going to take a piece of the pie. So you can't really figure out a per hour cost, but think 3 or 4% of whatever we end up doing. And then there's ancillary costs, other stuff as well. Think about this one. Orange County filed for bankruptcy. Their bankruptcy was $1.69 billion. Their legal and accounting fees were $29 million on top of that. Their administration fees were $115,000 a day. They had to set up, for this $1.69 billion bankruptcy, a separate pool of $50 million only to cover these fees. Okay. In the average bankruptcy fees are estimated between 2 and 10% of the firm's assets. So bankruptcy is not cheap. It's probably a joke here, but I'm not going to make it because I've been told not to. But bankruptcies are expensive. The anticipation of this expense is part of our financial distress costs. All right, we're going to have indirect costs as well. So those are the direct costs, the lawyers, the fees, etc. Now, what happens if we're chugging along merrily in our company? Things turn a little bit sour. Now we start to feel the early signs of financial distress. We don't have the pool of cash necessary to keep all of our raw materials that we need. The inventory is too expensive, so we cut back on our inventory. Maybe we've let a couple of people go, so we don't have that to worry about either. All of this is harming our relationships with our clients and suppliers. When I run a company, or I'm a salesperson for a company, and I get a call, and the company says, tell you what, I love these chairs you sell. I want 1,000 of them, please. And you have to say, normally I would have those in stock, but you're going to have to wait a few weeks because we have to build our supply back up. You get a chance to do that once or twice. If that becomes part of your everyday business, your clients are going to go somewhere else. 75% of Americans said they would not buy a car from a firm in bankruptcy. It makes sound sense, right? Warranty, parts, etc. Every car maker in the US has been in bankruptcy. GM, Ford, Chrysler, who's left? The Pontiac was, that's basically all that's left, right? Dodge is part of Chrysler, etc., etc. So they've all been there. It's almost impossible to measure these indirect costs, but they exist, and it's somewhere between 10 and 20% of the firm's value. Think about it. When your sales drop off because I can't count on you to be my supplier anymore, that's going to have an impact on the value of your firm, right? Let's talk about a very specific merger, Texaco, Getty, and Pennzoil. Pennzoil agrees to buy Getty Petroleum. Just before it's about to close, Texaco outbids them. Pennzoil, Getty says, off Pennzoil, I'm going to take Texaco's bid instead. Pennzoil says, wait a minute, we had an agreement. I'm going to sue you for $12 billion. Texaco now, who had outbid them for Getty, files for bankruptcy. You can't take that $12 billion. They don't have it anymore. The second they do that, Texaco stock gets hammered. The market value of their company dropped by $4.1 billion. Pennzoil, who's going to sue and win for $12 billion, only goes up by $700 million. Why? Why? Why does Texaco, who now has to pay $12 billion, lose $40 billion, and Pennzoil, who's going to collect it, only gets $682 million? The indirect cost, the direct costs were what they are, 165 and 200. But what's the difference? Why does one lose 4.1 billion and one only makes 682 million? And the difference is we have a different impact on our ability to effectively run our business. Texaco got hit with a $12 billion lawsuit and has to pay it. Do they have the money? Probably. Is it going to be expensive? Yeah, it's $12 billion. But they can pay it. What's Pennzoil going to do? They're going to get the $12 billion. What are they going to do with that $12 billion? Are they going to pay it out as dividends? If that's the case, the shareholders are yay. But if it was being paid out in dividends, I would have expected to see their stock increase by more than $700 million. I would expect to see increase a lot more than that. So there must have been something else they were doing with that money. I don't know what it is, but if we dug far enough, we could answer that question. So we have direct cost of financial distress, and we have indirect cost of financial distress. We have to account for both of those. We have to realize that when we go down the road of issuing debt, we take on the extra risk. And when we take on that extra risk, we better be prepared for financial distress. Is it going to happen? Probably not. But you know something? If it does and you have not prepared yourself for it, you're going to be in a lot of trouble. And then agency costs. This isn't what you think. If I said agency costs, it's logical to think that there's a company involved with agents and somehow those agents are going to charge more and it's not what's happening. Excuse me, it's not what's happening at all. In this case, the agency costs are what the people involved do to try to shield or protect themselves from an unknown outcome. When a firm has debt, you're always going to have conflicts between stockholders and bondholders. Always. Those conflicts are what cause the agency costs in the firm. So there's no agent involved. It's a weird term. But think about it. I have stockholders and I have bondholders. Who gets paid back first? Bondholders. What do the stockholders get? Whatever's left. If there's nothing, it's nothing. So there's an incentive for the stockholders to try to keep hold of something. Now, if you know that my downside is limited to my investment as a stockholder, but my upside is pretty much open to whatever the company can end up earning, you may get incentive to take unnecessarily large risks. You may also get into a position where we underinvest in the company. Am I going to get more for it? Nah, then I don't pay any money for it. And then we have something called milking the property. We're going to get back to all these in a second. Taking large risks. When we approach bankruptcy, some firms take larger risks because they're playing with house money at this time. It's not going to get worse. So imagine two projects with different risk profiles. We have a low risk profile. If a recession hits, the value of the firm is $100. If a boom hits, the value of the firm is $150. The expected value in that case is the $100. The wrong way here. If a boom hits, it's worth $200, and the expected value is $150. I'm sorry, because we have a 50% chance of being 100. We have a 50% chance of being 200. The net is $150. So I'm going to fix that. The expected value of the stock is then a half times 0 plus a half times 100. Because we have 0 stocks and bonds, etc. Right? In our high risk firm, if a recession hits, the firm's value is $50. If a boom hits, the value is $450. What's the expected value? 0.5 times 50 plus 0.5 times 240, so it's 25 plus 120, $145. The expected value is for stock is $70, which is 50% 0 and 50% 140. An investor would likely pick the higher risk project. We have a better chance of making more money. In a recession, the investor, the stock investor, receives nothing anyway. In either case, the stock is worth 0. If my downside is limited at 0, irrespective of what happens, why would I not go for the opportunity that gives me a better return? So one of the associated costs with financial distress is stockholders forcing the company to take on larger risks than they naturally would, because they're acting in their own self-interest. And people will always act in their own self-interest. True altruism is very hard to find. You may think that I'm a bit of a skeptic here, and I am, but given the opportunity, very few people would say, have my money. What's the second problem? Incentive to underinvest investment. Now, think about this one. I'm a real estate owner facing bankruptcy. I have a building. If I invest $100,000 in this building, I know I can increase the value of that building by to $150,000. So I know I can get a 50% return on my investment. The problem is, in the event of bankruptcy, I get nothing. So my risk is I get 150,000 or I get nothing. Now, even if the project has a positive NPV and with a 50% return, it's got a positive NPV, why would I risk investment if I don't get a payback? Once again, we're playing with human nature. I'm going to look in my best interest. This is called debt overhang. If the debt blows up, I see nothing. And in that case, I'm not going to put more money in because I'm just chasing good money after bad at this point. Now what happens? And the third, wait. Good example. All right. We've got a project that costs $1,000. If we do not do the project, we have $5,000 cash flows. In the event of a boom, $5,000 cash flows. Bondholders' claims are $4,000, and that leaves $1,000 for stockholders. In the event of a recession, we get $2,400 in cash flows. We still owe the $4,000. We use all $2,400 to pay the $4,000, and there's nothing left for stockholders. Okay. Now we have a project that's going to cost $1,000. If we have our investment, we are going to generate $1,700 in the investment. That gives us, with a boom, $6,700 in cash flows. In a downtime, we don't have $2,400 in cash flows. Now we have $4,100 in cash flows. What do we have? We have our bondholders' claim is $4,000. We have $6,700 in a boom. So we have $2,700 to pay off to stockholders. In the recession, we're at 4,100 now. We owe 4,000. We only have $100 left for stockholders. So even though it's the right thing to do, even though it's got a positive NPV, we're not going to invest because the most we could get out of this in the event of a recession is $100. If we did nothing, the most we would see is zero. To get to this $100, we had to invest 1,000. Why would I invest 1,000 if my return is only 100? Now, what's my expected return? Well, my expected return in the first case, if it's a boom, I get 1,000. If it's a recession, I get zero. My expected return is 50% of this and 50% of that is $500. My expected return here is $900. 2,700 times half plus 50. But costs are still 1,000. So my expected return still is never going to make it as high as it's going to cost me for this project. So I will never, as a stockholder, say, that's a good idea. Please go ahead with that. This has given me an incentive to underinvest in the company because in bad times, I'm never going to see it back. I'm the last guy on the totem pole. Everybody gets paid before me. So if you ask me my opinion, the opinion is do not invest in this company. And then we have something called milking the property. Milking the property is kind of what it sounds like. How can I get value out of this company without putting more value into this company? We're going to pay out extra dividends. Do cash payments to stockholders. You know, if we're in a time of distress, and I know I'm not going to get any of it back anyway, can I talk you into giving me a dividend? It happens. It's known as a wealth transfer. It's known as milking the property. Keep your stockholders happy. When Marriott spun off, Marriott was spun into Marriott International and Host Marriott. Equity holders that were holding Marriott got a stake in both Marriott and Host Marriott. The bondholders, however, only got a stake in Marriott. Sorry, only got a stake in Host Marriott. They didn't get a stake in Marriott International. They lost their claim on the assets being transferred. As a result of that, we have something called debt covenants now. We'll get into that in a minute. But you can see how if we see returns starting to tick lower, we have ways that we can pull money out of the company as a stockholder to protect myself. Does somebody end up getting the shaft? Absolutely. But if I'm thinking of my own selfish self-interest, I'm not that worried about it. So, can costs be reduced? Well, yeah, we can, absolutely. All the costs of financial distress are substantial, and as a group will impact debt financing. Can we mitigate some of these somehow? We can. We can mitigate them in a couple of ways. And you can, I've talked about my spelling before, so I'm not worried about that much. We have protective covenants and we have consolidation of debt. It's not debt, it's debt. What are protective covenants? These are things that we put on, these are clauses, not things, but clauses we put on the debt agreements to limit what can be paid. The stockholders have to pay higher insurance rates against their own selfish strategies to cover some of these costs. We're going to offset some of these by making agreements with bondholders to try to lower the cost of those bonds. How do we lower the cost of bonds? We get rid of some of the financial distress costs or likely financial distress costs. We get rid of a lot of these risks. Some of these risks are from this Marriott story right here. I'm going to limit what can and can't be done if I lend you money. The protective covenants, they're part of the loan document between stockholders, the owners of the company, and bondholders who are lending them money. A broken covenant can lead to default. So if I have loan a loan outstanding to you or a bond outstanding to you and you violate your covenants, I call it immediate. If you can't pay me, I'm pushing you into bankruptcy. So that's the downside of covenants. Now, there can be two types of covenants, positive covenants and negative covenants. A negative covenant says you can't do this. I'm limiting the amount of dividends you can be paid. I'm making sure you cannot pledge assets that you've already pledged to me for my stuff. Can't merge, because if you merge, we have an uncertainty of what happens to the stuff that I have a claim on. You can't sell or lease out any of your major assets that I might already have a claim on. And if we've done a debt issue with me, you can't do debt issues with anyone else. How common are these? 23% of the time, there's limitations on dividends that are paid. 39% of the time, you can't merge. 36% of the time, don't touch any more assets because I got claims on them all. And can't issue more debt, that's 91% of the time. So covenants are real. They exist and they're at play all the time. Positive covenants, what you agree to. I will do this. I will maintain a certain level of working capital. I will furnish periodic financial statements to the lender. I will set up a board as you dictate and staff it with anybody you want to. And in fact, if you look at the chart on the right, as firms approach financial distress, what do we have? We have financial statement restrictions, minimum working capital, interest coverage, and net worth. We have shareholders maybe trying to transfer some of the corporate wealth to themselves before anything happens. So we're going to limit dividends. We're going to limit the sale of assets. We talk about collateral and mortgages and stuff like that. We'll talk about shareholders attempting to increase risk in the firm. Once again, we're saying restrictions on what you can switch. You can't use that. You can't pledge this, etc. I'm going to stop now and take a 10-minute break. And when we come back, we're going to talk about the integration of tax effects. So I'll stop recording and go get a coffee or something, and we'll come back in 10 minutes. Welcome back, everybody. I have now got my audio and video going, and I'm taping, so we're good. Now we talk about the tax effects. Remember when we talked about Modigliani and Miller, there was a bunch of caveats that we had to assume. One of them was no taxes. Well, the reality is, in the world, there's only a couple of things that we know of for sure. One is death and one is taxes. So taxes are coming. That's not a problem. Now, if we agree with Modigliani and Miller and all those caveats are held, then a firm should choose maximum debt to maximize value. Maximum debt increases the risk increases the return maximizes their value. Now, this is where the real world comes in to have a chat and taps you on the shoulder. Other costs step in to reduce the value of the levered firm. Bankruptcy costs, taxes go up, we have interest costs, we have the costs of financial distress, etc. Now, if we were willing to assume that none of these came into play, then the top line would show you the present value of the firm, the total value using equity and bonds. Part of this is the value of the tax shield. The present value of the tax shield is something, one of the primary reasons why we issue debt, because we have this tax shield associated with the interest rate payments. The present value of that is going to be a straight line. The reality is, though, there is a point after which the extra costs involved in issuing debt start to weigh on the debt. And what we actually have is the yield, the curve of this turns not to be straight, but it turns to be somewhat of a log normal curve. Can't go below zero. It can go way higher, but at a massively declining rate. So what we actually get is a difference between what the optimum return we could get under debt and the return after we start to eat into our tax shield savings with the financial distress costs. And there's going to be a point where as you get more and more debt, the likelihood of financial distress goes higher and higher and higher, and the costs associated with financial distress overwhelm the benefits of your tax shield from the interest. So we actually get, there is a point where we've hit the optimal amount of debt we can have. We have maximized return to the firm, and now we're only going to go downhill from here. If you want, we can flip that chart over and say, what's our cost of capital look like? There is a point where we have hit the ideal combination of equity and debt to maximize the value of the firm. And if we vary on either side of that, if we reduce our debt burden below our optimum amount of debt, then the present value of the tax shield is also going to be reduced. If we go the other way, the present value of the tax shield is now going to be offset by a higher and higher and higher financial distress cost as we put more and more debt into the equation. So we have a curved line that says somewhere in here is the ideal debt for our firm. The maddening point is I can't tell you exactly what that point is. I'll tell you in theory how we get there. I can tell you what happens when we vary on either side of it. I don't have a magic formula that tells us exactly what that number is. So we kind of have to iterate to it. And we've got this out before when we were looking at internal rates of return and stuff like that. Yeah, sure, we have spreadsheets that can do it for us, but if we had to do it by hand, we can only do it by iterating. That's too high, that's too low, get closer, get closer, get closer until we get to the right one. We can do the same thing with our magic combination of debt and equity, but it'll make you nuts to try to do it. So, at some point, the present value of your distress costs are equal to the present value of the tax shield. That is your optimum level of debt. Vary too much the left way and reduce your debt, and the value of your tax shield reduces. Go too far to the right, and now the financial distress costs have overwhelmed that, and we've got too much debt. So we know where this point is likely to be. It's B star. We're not really sure how to get there, though, so stick with us. So the bottom chart is our weighted average cost of capital. As we add debt to the equation, as we add debt to the equation, it is honest to God, just water, okay? As we add debt to the equation, our weighted average cost of capital starts to fall. There is a point where we've used up all the benefits of our tax shield, and now we start to get that eaten up by our financial distress calls. The big problem here is we've got models for almost everything. We don't have a great forecast for financial distress. So if somebody wants a PhD, we've got one out there. We need a better way to forecast what our distress costs are likely to be. And we don't have it yet. So without that accurate forecast for distress costs, it's very hard to come up with an accurate model saying this is your ideal number. But that brings us back to our pie chart. So realistic, what's our value? What's the value of our fund? Well, we know what the asset side is. That's easy. The other side is a bit harder because what we have for sure is our bondholder claims, and for sure we have our stockholder claims. But then we have a bunch of other stuff in here. We have tax claims. We have bankruptcy claims. We have ancillary claims. Now, it's not an exhaustive list, but really what we're saying is we have payments that we have to make to our stockholders to keep them happy. We have payments that we're obligated to make to our bondholders, not necessarily to keep them happy, but because we're obligated to make them. And then we have two other groups. The government always wants their piece of the pie. So they're for sure standing out with their hands held out. But then we have the other guys, the stuff that results in a lot of these financial distress claims, legal costs, administrative costs, all the other stuff associated with that. And we're going to come up saying the value of our firm is equal to what we owe our stockholders, what we owe our bondholders, what we owe the government, and whatever we owe on financial distress claims. Now think about this one for a minute. How much would it be worth to a company to be able to get rid of those financial, the distress claims? If I could say, I guarantee you won't be sued, how much is that worth? A lot. It's also illegal. Can't do that. Now, I wish we could, but there's no form that allows me to pay you and never have you sue me again after that. It's not legal. It would be nice, and a lot of people try to do it, and jails are full of them, so be very careful. Notice that when I say the value of the firm is equal to what we owe the stockholders, what we owe the bondholders, what we owe the government, what we owe the legal, there's no discussion of capital structure. Because if we go back to Modigliani and Miller, the capital structure is not going to impact the value of the firm. We know that. We've proved it. So we can get rid of that. We don't care anymore. It's not an exhaustive list, but we know that the value of the firm is a combination of the claims against the firm. Is there a difference between all these claims? Absolutely, there's a difference. And the big difference is I can sell some of those risks away. The marketable claims by stockholders and bondholders, I can sell away. I can get rid of those risks. Somebody will always buy them from me because there are gamblers in the world that will always say, what's the probability of bankruptcy? What's the upside if if it doesn't go bankrupt? That's good enough. I'll take that. What are the stockholder claims? Generally speaking, dividends and whatever's left in the value of the firm, right? What are bondholder claims? Principal and interest. I can resell bonds. That's not a problem. I can strip dividends and sell those. That's not a problem. So what we end up with is a group of claims called marketable claims. The marketable claims are the claims that I can actually get rid of if I want to. There are a group of other claims that I can't get rid of in any way, shape, or form. I defy you to show me how you can sell the government's claim on your company. You can't do it. It's not possible. How do you sell the legal expenses? You can't really do it. So we'll call those non-marketable claims. Rational managers are likely to choose a debt structure that minimizes the marketable claims. They're also going to try to minimize the non-marketable claims, but that's way harder. Because to get rid of the legal costs, we have to assume that nobody's going to sue us, and that's unlikely. To get rid of the government obligations, we just can't. So we have a group of marketable and unmarketable. We're going to try to minimize both of them, but we can't minimize them both at the same time. Why? Because of something called signaling. And signaling, remember I said there was an assumption in Modigliani and Miller that there's what was the exact term? The exact term was, oh, I remember this stuff, but not right now, sorry. Yeah, I remember. Anyway, The problem is when everybody has access to news, everybody assumes they know everything. They don't. You can never know everything. Nothing could be truer than the financial markets. The second you think you know all the information out there, there's a new piece of information. And you know something? Not everybody knows this at the same time. There is not a free flow of information in the world. It's asynchronous. It is not distributed properly. We know that there's a trade-off between tax subsidies and financial distress costs. What we don't know is the impact when we do something. If a company issues stock, what message does that send to the market? If they issue debt, what message does that send to the market? Remember when we talked about Enron? I think we did talk about Enron. We didn't talk about Enron when we talked about Enron. The problem was Enron lied very specifically. And then they started to release information into the market. As they were releasing information in the market, there was a growing consensus, this can't be it. There's got to be more. I refuse to believe that's the only problem. So every time another dribble came out, the market was expecting a flood. This is signaling. So, the capital structure is optimized when the marginal subsidy to debt equals the marginal cost. When my tax benefit from these interest payments is offset by the costs of financial distress, we have hit exactly the optimum point in our capital structure. We need to explore the profitability of a company compared to the debt level. So when we look at debt, let's look at how we value a company compared to that debt. We can already do assets, it's fine, we do equity too. We're going to look specifically at debt. Low anticipated profits usually lead to a low level of debt. There's a reason for this. If I have small profits and big debt, then I have a problem. And the specific problem is if I have very little income and a lot of debt, if I get a change in interest rates, then the interest payments I owe on that debt jump exponentially compared to my income. So it's a good probability that if I have low income, I'm not going to be able to service my debt. So if I have low income, I'm not going to get a lot of debt. The more successful a firm is, the more probability that they'll be willing to take on debt. Rational firms raise debt levels when profits are expected to rise. Rational investors infer higher firm value from a higher debt level. Put those two together for a second. If a rational company is going to issue more debt when profits are expected to rise, then as an investor, I look at a company that says they've just issued debt, they must be expecting profits are about to rise. I must have some of that debt. That's the way it works. Investors view debt as a signal of the value of the firm. If you are confident enough in your profit potential to issue debt, I should be confident enough to buy your stock. Now the problem. We all know this. We all know what investors are viewing. We all know that debt is a signal. Do companies ever issue false signals? Do they ever try to fool investors? They shouldn't. But do they? Absolutely. Consider a firm that's at their optimal capital structure. If I add more debt, I incur more distress costs, and I'm going to get lower returns. If I take debt away, I'm going to drop the tax shield for my interest, and I'm going to have lower returns. So I'm right at the sweet spot. Marginal tax benefits equal distress costs. This is sweet spot. Now, what if I want my stock higher? Pick a reason, I don't care. I've got a favorite investor then that wants to sell his stock, so I want to get the stock up as far as possible. Maybe it's me. Maybe I'm the president of the company, and I'm about to get my stock options vest. I've got a dramatic self-interest in driving the stock price higher. And to me, that's one of the problems with stock-based compensation, but for a different day. So there's a reason I want the stock level higher. What if I issue debt? Knowing that there isn't really a prospect for future earnings, but I want that message in the market. I want investors to look at me and say, he just issued debt. He must have great expectations of what the future brings. This is going to push the stock higher. Can I increase leverage at no cost? No, I can't. If I increase leverage, my financial distress costs are going to go up. Eventually, yeah, it's going to result in a slow move higher than stock. That's not a problem. It's going to accomplish what I want it to in the short term. In the long term, investors are going to see the increased debt and no increased profits, and then you have this aha moment, I got shafted. They're going to push the stock price right back to where it was or more. Now, you might say, how can people be that stupid? That doesn't make any sense. We've got very bright people out there. The reality is people can be that stupid. A company just went bankrupt yesterday, and I'll see if I can find it here. Just give me a second. I was looking at it earlier, and I had to close it because I have great Wi-Fi up here. Auto parts company that went bankrupt. First Brands. First Brands, $11.6 billion in liabilities. Is it huge? No. However, they were suppliers to Napa. They were suppliers to all of the other car parts companies that put parts into your car. They were also guilty of a lot of signal, a lot of monkeying around with returns. And when they went bankrupt, the question was, how is it possible that they were able to get this much debt using these few assets? And they pledged again and again and again the same assets. And they factored stuff again and again and again. So when everything started to be unwound, there was nothing left to unwind. Signaling theory is backed up by empirical evidence. It happens all the time. Excuse me. For example, exchange offers. Firms can change their debt levels through exchange offers. I'm going to allow investors to exchange some stock for debt, or debt for stock in some cases. If we do stock for debt, we're going to increase leverage. If we do debt for stock, we're going to decrease leverage. Both of them are perfectly legal. The solid line on the right says what happens when I do an exchange offer that increases leverage. I'm exchanging stock for debt. In that case, day 0 is the day we do it. The days leading up, we have a slight tick down. The day we announce it, we have an explosion higher in the return on our stock. That remains positive for up to 50 days. On the other side, if we decrease leverage, so now we're doing a exchange debt for stock, which is not as common, but it happens. The line that heads straight down shows what happens. There is an expectation in the market. If I de-lever my company, if I reduce the proportion of debt to stock, there must be a reason. Might not be true, but that's certainly the way the market behaves. So this is signaling. Exchange offers very closely signal. Now, what about agency costs? Remember I talked about agency costs, and agency costs talked about When we have disputes between bondholders and stockholders, the costs that are derived from those disputes are agency costs. A couple of centuries ago, there was an economist called Adam Smith. He's a free market economist. Um, the synthesis of what he says is an individual work harder for a firm if they're an owner rather than just an employee. The corollary of that is the larger your ownership share, the harder you work. Is this necessarily true? I don't know if it's necessarily true or not, but there is some empirical evidence to suggest it's at least partially true. Human self-interest says, if I get something out of it, I'm putting more into it. If all I get out of it's a salary, I'm putting the same amount into it irrespective. I don't care. So there is some empirical evidence to that. Let's consider Miss Paydown. She owns a computer services company worth $1 million. To grow, she's going to have to add $2 million in capital. Do we borrow this money or do we issue stock? If we borrow, we're borrowing at 12%. If we issue stock, we have stock transaction prices, which we're not getting into, but that's the real issue. The question now is, what does that motivate her to do? There's two choices. I can work a regular 6-hour day, or I can work 10 plus hours. If I work a 6-hour day, I'm going to generate cash flow of around $300,000. If I work a 10-hour day, I'm going to generate about $400,000 in cash. If I have to borrow $2 billion by issuing debt at 12%, my interest cost is $240,000, 12% of $2 million. My cash flow after my working either 6 hours or 10 hours, if I work 6 hours, I make $300,000. After I pay my interest, I have $60,000 left over that I flow into equity. My 10 hours, I make $400,000. I pay $240,000 interest. I flow $160,000 into equity. So either I flow in $60,000 or $160,000. My expected, let's assume it's 50-50. So my expected is about $100,000. If I raise my equity, then my $300,000 becomes $300,000 because no interest cost. If my $400,000 becomes $400,000 interest cost. So if I work 6-hour days, I either make $60,000 using debt or $100,000 using equity. If I work 10-hour days, I either make $160,000 using debt or $133,000 using equity. In a curious way, Ms. Pagel is incented to work harder if she issues debt than if she issues equity. Now, there's a bunch of philosophical ways around this. I mean, you're playing with house money. It's not something you're worried about, blah, blah, blah. But the reality is your expected earnings are higher under leverage than they are under no leverage. That's the agency cost of equity. If I issue equity, it's only to me. If my expected returns aren't that great, I'm not going to put the effort in. And that's reality. So we have a choice of issuing debt and working harder for the money, or stock and working less for the money. It's not necessarily that easy. Because who decides on perks? Who decides on perquisites? Owners of the company or bondholders? It's owners of the company. If she's the sole owner of the company, she gets everything, right? If she has issued debt and now only owns 1/3 of the company, 2/3 of all the costs she incurs are shouldered by someone else. If she's the sole owner of the company, they're all her costs. So once you start issuing debt, now we have another problem. We're more likely, because we're using somebody else's money, to make capital budgeting decisions that are not optimal. We might consider something with a negative NPV. We also might engage in empire building. We might start to acquire our firms by overpaying for the firm or the project. Consider the managerial size, the salaries. Absolute empirical evidence that the larger a company gets, the more managerial salaries go up. If a project results in higher pay, but lower stock performance, the manager with a smaller equity interest, they don't like to be as bothered, right? I don't care. If we get too many of these dodgy capital budgeting decisions, we're going to bankrupt the firm. Agency costs are soft payments to entrepreneurs in terms of work hours, expense accounts, larger offices, unprofitable investments. These are real costs that have to be considered when you decide bonds versus stock. And it becomes especially true in smaller companies. The owner's share in a smaller company gets diluted much more quickly. All right. So who bears the agency costs? We know the costs are there. Who pays them? Is it the current owner of the stock? Or if I issue more stock, is it the new stockholder? If it's a new stockholder, guess what? They're building those agency costs into the value that they put towards their stock. They're idiots. They know it's there. We talked about sandbagging before. We know it exists. It's part of human nature. There's nothing you can do about it. But when I buy into a company, I have to put that expectation into the price I'm willing to pay. But what if I want to reduce covenants? Well, if we reduce covenants, then we have to find some other way of accomplishing what we would have accomplished with those covenants in other manners. We're going to create a different board. We're going to have reporting, surveillance. The cost that we're not going to incur because of the covenants that we are not using, we're going to try to mitigate with their reporting, surveillance, the board, etc. There is some suggestion that the cost of equity is reduced significantly in leverage buyouts. One of the strange things about leverage buyouts is, yeah, they're using a lot of debt and whatnot, but the managers are now the owners. And because they're now the owners, they're going to work harder as the new owners than they did before, because it's their company. They're going to actively serve as their own surveillance system. That's the theory, anyway. What's the effect of agency costs on debt equity financing? We always have this conflict between bondholders and stockholders. We cannot get rid of that. We know that on bonds, we have this offsetting tax shield on the debt and our increased financial distress costs. When they balance out, we're at the optimal stage. Now we have to choice to change the value of the firm. Are we going to do that by increasing the tax shield on debt? Or we're going to try to reduce our agency costs? Or what else? Well, then now we have a formula, actually. The change in the value of the firm is the tax shield on this debt, plus the reduction of any agency costs in equity, minus the increased cost of financial distress. So as we add debt, yes, we're getting a better tax shield on the debt. As we add debt, we are reducing the agency costs of our equity, that's true, but we're also increasing the financial distress costs. We have to recognize that. The other thing we have to pay attention to is the free cash flow. Think about your favorite crime show. Criminals need two things, right? They need motive and opportunity. We already talked about motive. Why we do something. I want to increase my profitability. I want to get to an optimal debt strategy. Fine. I'm going to work in my own self-interest. That's our agency costs, right? We know that. That's our opportunity too. Now, the thing is with free cash, I can only pad my expense account if there's actually money there to pay me. If there's no free cash flow, it becomes significantly more difficult to conduct any malfeasance because there's nothing to pay yourself with. This is called the free cash flow hypothesis. You're going to see more waste in high cash flow companies than in low cash flow companies. Absolutely 100% true. High cash flow also empirically leads to way more bad acquisitions. We have cash lying around, let's buy something. It's also going to result in an increase in dividends. If I have cash, I'm going to pay it out to my stockholders. If I have less cash, I'm going to pay less out to my stockholders. Adding debt also reduces my free flow of cash because now I have interest payments. I will also have more insolvency risk, I have more interest payments, I have more fees, etc. Right? Bond payments should have more of an impact than dividend payments. Let me say that again. When we start to add all these payments together, we have to think about the legal liability attached to these payments. Bond payments are part of a contract. You have no choice. You have to make the interest payments, you have to make the principal payments. Dividend payments are not contractual. Whatever's left, we'll pay out. I'm not legally compelled to pay dividends at all. I am legally compelled to pay all my bond payments, so they're not equal risks. So let's consider a financial manager in need of capital. Getting close. We have a choice now. We have a choice between debt and equity, and we've beaten this horse. We know that we have a magic number where the we've hit the right number, right amount of debt, because anything more, we have increased financial distress costs. Anything less, and we lose the benefit of our tax shield. So we've got this sweet spot. What we have not discussed is timing. Consider this. If I go to issue stock, we talked about signal. Same with debt. If I go to issue debt, we talk about signal. People will buy the stock in anticipation of higher earnings because that's what I have signaled. But now consider this. What if I've got a stock that's worth $60 a share and it's only trading at $50 a share? There's $10 of free money in this stock. You got to figure out a way to exploit this $10 because that's what we're always going to do, right? If we issue bonds, our stocks are going to go up. That suggests that we should probably only issue bonds if we consider our stock to be undervalued. In fact, empirical evidence supports this theory. Managers are more willing to issue stock at a high than after it's fallen. Because the expectation is that if a stock is falling, it's going to continue to fall. Don't grab fallen knives. Asymmetrical information is the key that makes this work. What do I mean by that? If I am sitting in the CFO's office, I have significantly more knowledge of what's happening to the finances of this company than anybody else on the planet. I don't care if you're in a hedge fund. I don't care if you're in a bank. I don't care where you are. I have more information than you have. It's asymmetric. That means that I have more knowledge about what the actual value of my firm and the stock should be. So I should have more knowledge of when I'm overvalued and undervalued. If I issue bonds, it must mean because I believe my stock is undervalued. Conversely, if I issue equity, the negative signal to the market is I believe my stock is overvalued. I'm selling it now because it's trading at 60, it's only worth 50. I want that 10 bucks. That's why I'm issuing stock. That's exactly the signal the market's going to take. So we also have to consider other things. I mean, we're also going to consider taxes, financial adjustments, costs, agent costs, etc. Right? But we can only issue debt up to a point. After that point, we've passed the magic number, and now our financial stress costs become higher because financial stress becomes a bigger and bigger and bigger and more real and more real and more real probability. The more debt I issue, the more the likelihood is I'm eventually going to have to go bankrupt. Is it going to happen today? No. Is it going to happen tomorrow? Probably not. But if I had no debt at all, it wouldn't happen at all. So the more debt I have, the more the risk increases. So we have a couple of rules here. First rule, use internal financing. We have to be careful with this one because you can't insider trade. It's illegal. And they may not catch you if you rob a bank. They may not catch you if you kill someone. They're going to catch you if you insider trade. You've got to trust me on this one. This is one you don't want to do. Managers can't use inside information or knowledge to determine if debt's mispriced because interest rates are comparable for issues of riskless debt. Think about this one. If I am the government of the United States at AAA, they're not, but if they were at AAA, and the government of Switzerland at AAA, their bonds should carry approximately the same interest rate. We're going to call it riskless debt because they have not defaulted on that debt yet. All countries can't say that. And in fact, the US might not be able to say that someday too. But for the time being, we've never defaulted on our debt, so it's riskless debt. No corporate debt is riskless debt. They are not backed by the unlimited financial capabilities of the country. They are backed by their very limited financial capabilities of their company. So it's not riskless. It all has a risk of default. Not all corporations have the same risk of default. This is what leads to bond pricing. And we saw that when we talked about our bonds 2 weeks ago. The price of the bond changes depending on the riskiness of the bond. Now, if a manager sees financial trouble ahead, they might see their debt as overvalued. The public might see it as risk-free. The managers know one thing, the public knows something else. This leads investors to be skeptical about debt. And they're also skeptical about equity, but they're very skeptical about debt. So we try to use internal financing first to get around that. Rule number 2, issue safe securities first. Investors are very afraid of mispricing debt and equity. Investors are significantly more afraid of mispricing equity than they are of mispricing debt. If I misprice equity, I'm stuck with all this equity. If I misprice debt, I just write it down and get rid of it. That's not a problem. I'm way more afraid of being stuck with this equity. If financial distress is avoided, investors receive a constant return with debt. If outside debt is used to finance, it's going to be repaid before equity. Want to be careful about issuing convertibles. Convertibles are a problem that they should never have been invented, but they were, and they're just, it's a pain. Straight debt is paid before convertible debt. So what we're going to do is we're going to issue our safe securities first. Then we're going to get, as we start getting full on that, remember there's a maximum amount we can issue, we're going to start issuing less safe securities. So remember, we go safe first and then less safe after. What are the implications of this? The big implication is there is no target amount of leverage. I can't tell you what the magic number is. I can't. Optimal leverage is when the marginal benefit of your debt is equal to the marginal cost of your debt. We know that. I can't tell you what either of those is, so I can't tell you what the magic number is. This implies there's no target for the amount of leverage. So what we're going to do is we're going to first fund from retained earnings. We're going to pull money out of the company first, right? It raises the book value and the market value of equity. At some point we're going to run out of how much debt we can issue. And our leverage ratio is going to determine what projects are available to us. But remember, we don't have a target, usually. I'm going to show you that's not necessarily 100% true. Another implication, profitable firms use less debt. Profitable firms generate cash internally. They require less funding. If they do need funding, they return debt before they do stock, but they may not have to use debt. And that kind of flies in the face of what we said before, where when we're signaling, for me to issue debt suggests that I expect profitability down the road. If I'm already profitable first and I don't require debt, then we get a little problem there. And lastly, companies like, actually, I don't think it's lastly, I think you have 5 of these. Companies like Financial Slack. They like to see cash hanging around. Skeptical investors see stock as overvalued if managers try to issue it. That's going to push your stock down. It doesn't happen to bonds as much. So if I'm less concerned about that, I might issue bonds first. All right. And now taxes. We got to talk about taxes. I apologize ahead of time, but we got to do it. Because interest on debt is tax deductible in the US, whereas dividend on stock are not tax deductible, there's an incentive to issue debt because it's going to be more accepted than equity. Now, remember, corporations aren't the only ones paying taxes because the investor has to pay taxes too. So let's kind of pull this apart and have a look at it. What's the effect of these taxes? Let's look at an all equity firm. And it's got $1 of pre-tax earnings. The corporate tax rate is TC. So after earnings, what we're going to stuck with is 1 minus TC, 1 minus the tax rate, right? Assume it's all distributed to stockholders as dividends. Assume there's a tax on those dividends of TS. So what are we going to look at? Stockholders are going to pay a tax of 1 minus the corporate tax times their own tax. That leaves them of 1 minus the corporate tax times 1 minus the personal tax after tax. If it's all financed by debt, though, the $1 has to be paid out of interest on the debt. The interest is tax deductible at corporate level. So a personal tax rate is 1 minus the bonds after taxes. You can see that there's a difference in tax rates. On equity that's paid out as dividends, you have to pay both the corporate tax and the personal tax. On debt that's paid out as interest, I only have to pay personal tax. So there's going to be more left over after the fact. So taxes are an issue we have to consider. Do we need to consider personal taxes when we talk about the capital structure? Well, we need to answer 3 questions. What's the optimal structure if dividends are taxed at the personal rate? When is a firm indifferent to debt versus equity? And what should companies do in the real world? Those are the tax on the capital structure first. If dividends are taxed at a personal rate, personal tax rates are equivalent to bond rates in this case. Should the firm choose the capital structure that gets most cash? The firm should choose the capital structure that gets most cash in the hand of investors. Remember, investors own the company. They want the most money they can get. So, for $1 of corporate earnings, investors expect to get 1 minus the corporate tax rate times 1 minus my personal tax rate, while bondholders are expected to get 1 minus the bond rate. If the tax on dividends and the tax on bonds is the same, if my personal tax rate and the tax on bonds are the same, bondholders are always going to receive more than stockholders because stockholders also have to pay the corporate tax. Income is taxed twice, once at the corporate level, once at the personal level. And on bonds, it's only taxed at the corporate level for bonds. So that was the first question. When is the firm indifferent to debt versus equity? And what I said before, we're going to try to get the most money in the hands of our investors. And we're going to choose the capital structure that does that. If I'm indifferent, then the capital structure of equity must equal the capital structure of bonds. When 1 minus the corporate rate times 1 minus my rate is equal to 1 minus my rate, I will be indifferent. Does that ever happen? Well, no. So that's not a problem. What should companies do in the real world? Well, we're going to work on the highest tax bracket to start with. In the US, it's corporate 21%, personal 37%, and a 20% tax on dividends. If that's the case, then 1 minus the corporate tax rate is 1 minus 21%, times 1 minus the personal tax rate. 1 minus the tax on dividends equals 1 times the personal tax rate. It ends up that 0.63 equals 0.632. Very small difference when you're considering personal taxes. It doesn't make that much difference. So in the real world, it doesn't make that much difference. If we were to assume no personal taxes, and at marginal rates close to 0, with only corporate tax coming into play, firms should issue 100% debt. Personal taxes will never be at 0, so it doesn't matter. So how do we establish a capital structure? Gotta be honest. Well, you expect no less, but I'll be honest with you. There is probably more minted PhDs in economics talking about the capital structure of companies than I could possibly count. Some of the most contested economic theories discuss exactly the capital structure of the company. So if you want to hop on the boat and get a PhD, this is where you go. The problem is there's a lot of theories and there's almost no practical application of those theories. You can't apply them. They don't work. Consider this. When we look at NPV projects, I can tell you exactly what that project returns. I can tell you the internal rate of return on that project. There's no question at all. However, when we look at capital structures, we always have trade-offs. We have the pecking orders. There's no formula for the optimum debt to equity ratio. We can talk around it. We know what happens when we're too low. We're too low, we have not enough benefit from our tax shield. If we're too high, we have too much of a cost from our risk bankruptcy costs. So we know what happens on either side of it, but we can't tell you exactly where it is. What I can tell you is looking empirically at most companies, most non-financial companies have a very low debt to asset ratio. There are some financial and non-financial companies that use no debt at all. Industries tend to clump. The capital structures within industries tends to be relatively similar. But between industries, significant differences. And remember when I said, where is it back here? There. Firms do not target a debt to equity ratio. Well, in the real world, most companies employ a target debt to equity ratio. And there's a reason for that. They're not doing it to optimize the value of the company. They're doing it because they're forced to. And the other thing to remember is capital structures of firms vary over time. So what do we look at? Chart on the right, countries. What's the leverage ratio of firms in countries? Korea has the highest leverage ratio at just about 55%. My eyes aren't good enough to answer this question. Australia is around 10%. Canada and the US are very close to each other at around 13, 14%. Those are all at the low end of the world. So we have a high 50%, a low 10%. We looked at 39 countries. The average is somewhere around 26, 27%. What motivates? Tax reduction is the primary motivator for issuing debt. How big is that? In the US, $420 billion in corporate taxes paid last year. So we haven't used them up, for sure. But it suggests that if they haven't issued that debt to eat up those tax payments, why not? They must clearly be past their optimum level. Financial distress costs have snuck their ugly head in. And I would suggest that there's a legal attachment to this that we can't quantify. The more likely you are to be sued, probably impacts your debt to value ratio as well. If we look at the really high debt to value ratios of Korea, Indonesia, I'm not sure that you have necessarily the rule of law backing you up on that one. There are some firms that use no debt. In the New York Stock Exchange, there's 100 firms that have no long-term debt. They're averse to leverage of any kind at all. They also hang on to cash. Cash and near cash levels way above their leverage peers. They also have one thing that's very common. high equity ownership, or high family involvement. It's my money on the line. Leverage adds financial risk. All equity firms won't accept that risk. Does that mean it curtails their potential growth? Absolutely. But it also limits the downside. And that's where the family firms come into play. There's a bunch of studies out here. The chart on the right looks at the capital structure of various companies. And it looks at from a perspective of what kind of industry I'm in, what's the growth, what size of industries. There's a lot of difference between these industries, and it persists over time. In high growth industries, debt ratios tend to be very low. That suggests that there's ample future investment opportunities. But without even naming names, close your eyes for a minute. Think about new companies that are growing, fast growth companies. In as much as I hate Elon Musk and I don't want to suggest he's doing the right thing, Tesla is a perfect example of this. It is trading substantially higher than it should be. Doesn't have the debt to support it though. The other flip side of that is industries with very high investments in tangible items have very high leverage. Construction, real estate. They borrow a lot in their companies themselves. And I said, don't use debt to equity targets. 392 CFOs were asked if their firms employ a debt to equity target. Most use targets. 37% have a flexible target, 10% have a strict target, 34% have some sort of a target, only 19% said, yeah, we don't target. None of them rebalance their targets as their stock prices change. Very kind of interesting though. So in the absence of a specific model, we have to think of three things. Taxes. Highly profitable firms have larger target ratios than less profitable firms. We know that. Types of assets. The cost of financial distress vary different types of assets. Higher investment in tangible assets have lower distress costs. Most of the value in intangible assets disappears in financial stress. If I have to liquidate my firm because I'm going bankrupt, nobody cares that I've got goodwill. Can't sell it. A higher proportion of tangible assets usually results in more debt. So we have an uncertainty of operating income. Firms with uncertain operating income have a higher probability of experiencing financial distress, even without debt. These firms are more probably, actually, I don't even say, they're mostly using equity. One, because they can't afford the debt. And two, what happens if I have uncertain operating income and it comes in low just as interest rates are going up? In that case, I'm not going to be able to cover my interest payments because interest suddenly has gone up and my income's gone down. Now I have a problem. So what do we have in terms of empirical studies? Capital structures of companies vary over time. We know that. I have three companies on the right here going from 1926 to 2008. We're looking book leverage and market leverage. We look at General Motors. Their market leverage has gone consistently higher since about 1974. Book leverage has traded under market leverage aggressively since then. If you look at IBM, it's almost different. Book leverage trades significantly above market leverage. And then we look at Eastman Kodak. I'm not sure why, because I'm not sure they exist anymore. Market leverage has exploded in one direction higher, and book leverage has exploded the other direction. And that's what I've got. Summary and conclusions. The cost of financial distress cause firms to restrain their issuance of debt. We know that. That's why we have our humped look with our optimal debt at the top. As we go lower than optimal debt, we're not getting the maximum effect of our tax shield. And once we go past optimum debt, our distress costs go up too much. Firms have an incentive to reduce costs as stockholders ultimately pay the financial distress costs. It's not the bondholders, it's the stockholders. Because financial distress costs can be reduced but not eliminated, firms will limit their use of debt after a certain level. Signaling theory argues that profitable firms are more likely to increase their leverage because extra interest payments will offset some of the pre-tax profits. The corollary is rational investors will infer a higher firm value from a higher debt level. Is it true? I'm not entirely sure. Modigliani and Miller would suggest yes. I'm not sure it's been held up completely. Managers owning a small portion of a firm's stock can be expected to work less and have higher expenses than managers owning a large piece of the stock. Pecking order theory implies managers prefer internal to external funding. If distributions to shareholders are taxed at a lower effective personal rate than interest payments, the tax advantage to debt is partially offset. And then debt to equity ratios vary across industries and over time due to taxes, the types of assets, and the uncertainty of operating income. And that's what I have today for you, my friends. Thank you very much. Have an exceptional Thanksgiving. I will talk to you all next week. A reminder, I believe next week is our midterm. I will confirm that. I will send something out on Tuesday, but I believe next week is our midterm. Thank you very much. Have a great evening. Have a great Thanksgiving.